The day started like any other in Washington, D.C. quiet, calm, until President Donald J. Trump took the podium with a declaration that would reverberate through the markets. He called it a correction, but investors knew better. The United States was slapping a 25% tariff on over $100 billion worth of Chinese imports, citing years of intellectual property theft, unfair subsidies, and an imbalance that, in Trump's words, bleeds America. Wall Street responded within the hour. The Dow sank 750 points in a flash, Nasdaq reeled, and tech stocks Apple, Nvidia, Qualcomm took a sharp dive. Over in Beijing, the response was swift. China's Commerce Ministry announced immediate counter tariffs on U.S. soybeans, aircraft parts, and semiconductors. This wasn't just a policy disagreement. This was two superpowers pulling knives at the dinner table of global trade. Every hour brought a new headline. Every press briefing from either side moved billions in value. Now, for the investor listening, what does this mean at the surface? Tariffs feel like taxes on goods. But dig deeper, it's not just economics, it's a chess game. Both countries are fighting not only for trade dominance but technological supremacy. Chips, AI, energy, these aren't just business sectors, they're tools of power. By 6 p.m. estate market volatility had surged. The VIX Wall Street's fear gauge jumped 18% in one day. Funds started pulling out of emerging markets. The dollar strengthened, but so did gold, signaling that investors were scrambling for safety. Let's pause here. If you were watching the markets that day as a seasoned investor, you'd recognize this pattern. It's not just a one-day hiccup. It's the reignition of a long, painful battle. The 2018 to 2019 trade war was a preview. This was Act 2 and it was going to be messy. So, what sectors were at immediate risk? Tech, especially chip makers heavily reliant on Chinese supply chains. Retail, with goods like clothing and electronics facing sharp price hikes. Agriculture, which had become a political football with tariffs bouncing between American farmers and Chinese buyers. But here's what smart investors noticed. Defense stocks began to climb. Because beyond tariffs, this conflict hinted at something deeper, a cold economic war. As the sun set over the Pacific and markets closed, the global economy had changed again. And it wasn't just about numbers. It was about trust, about power, and about two countries who were done playing nice. April 6, 2025, 9 a.m. Eastern Time. In Silicon Valley, tech CEOs gathered in urgent board meetings. Chip makers were scrambling. China had just announced it would halt exports of rare earth minerals, an essential component for semiconductors, electric vehicle batteries, and advanced weaponry. Without these, America's high-tech empire would limp. By noon, supply chain directors from Seattle to Austin were burning up phone lines, chasing alternative vendors. Warehouse inventories were suddenly gold. Firms with diversified suppliers in India, Vietnam, and even Eastern Europe saw a spike in investor interest. Meanwhile, companies still married to China, they watched their stock tickers bleed. Across the country, the story hit very differently. In Iowa, wheat and soybean farmers stared at empty order books. China had cancelled all pending contracts for U.S. grain. This wasn't just a trade slap, it was a body blow to the agricultural heartland. Tractors stood idle. Barn doors closed early. Rural America was under siege. By 3 p.m., news broke that three major shipping companies, FedEx, Maersk, and UPS, were reporting significant cargo delays and surcharges. Containers were stuck in limbo at ports in Long Beach and Shanghai, with customs clearance at a standstill. Let's pause right there. From an analyst's view, this isn't just an inconvenience. This is systemic strain. Every extra hour at port costs thousands. Every day of delay dents quarterly forecasts. And every shockwave like this tells investors one thing: risk is rising. So how did the markets respond? Defensive stocks like Procter & Gamble, Johnson & Johnson, and utility companies saw mild gains. Energy markets were turbulent with China threatening to cut its US LNG contracts. Meanwhile, speculative investors started pouring into commodities like copper, lithium, and gold. And here's the kicker. The U.S. Treasury Department hinted that it might consider currency countermeasures. Translation: we were nearing a currency war, where not just goods but dollars and yuan would be weaponized. That night, small businesses held their breath. A toy importer in New Jersey saw his shipment blocked at Shanghai port. A California startup building smartwatches halted production as microchip prices spiked 40%. A trucking company in Ohio canceled routes because goods simply weren't arriving. This wasn't Wall Street theater anymore. This was real. This was personal. But here's where it gets interesting for our savvy investors tuning in tonight. A few companies saw opportunity. Amazon ramped up domestic warehousing and supplier support. Walmart re-announced its plan to invest in Made in America products. And Tesla, they went live with an announcement to expand their Mexican gigafactory, bypassing the Pacific gridlock altogether. This war, my friends, wasn't going to be won or lost in Beijing or Washington. It was going to be decided in the boardrooms, supply chains, and shop floors of every company trying to stay afloat in the storm. April 7, 2025, the third day of economic warfare. By 7 a.m., CNN ran a special report from Des Moines, Iowa. It followed a third-generation soybean farmer named Mitchell Hartley. His voice cracked as he pointed to 80 acres of unsold crop. "They say this war is about protecting America," he said, "but we're the ones taking the bullets." He wasn't wrong. For months, Chinese buyers had been the largest consumers of U.S. soybeans, but after Beijing retaliated with a complete halt on agricultural imports, farmers were left with silos full of grain and no market. By noon, social media lit up with photos of dumped produce. Farmers were offloading corn, milk, even meat. Prices had dropped so drastically, it cost more to store them than to destroy them. In Michigan, the auto industry was reeling. Ford and GM suppliers who relied on cheap parts from Guangzhou saw their inventories vanish overnight. A parts manufacturer in Grand Rapids laid off 70 workers in one afternoon. That's 70 families, just one domino in a rapidly falling line. At 3 p.m. Eastern, protests erupted outside a Walmart in Memphis. Not political protests, but frustrated consumers. Prices on basic electronics had jumped 12% in 48 hours, a direct result of incoming tariffs. A mother held up a tablet meant for her child's schoolwork. "It was $299 last week," she said. "Today $349. What changed everything?" Now, from an investment analyst's perspective, this chaos reveals something critical. Consumer sentiment was deteriorating fast. And when the average American consumer loses confidence, the broader economy begins to tremble. Retail stocks began bleeding red. Consumer discretionary took a hit. And perhaps most critically, credit card defaults began ticking up in early indicators. That's the kind of signal that seasoned investors monitor like hawks. Because when households pull back spending, Wall Street trembles. The American economy is built on consumer consumption, and this war was starting to freeze that engine. Meanwhile, in Texas, the energy sector was nervously watching Beijing's next move. China hinted it would cancel LNG liquefied natural gas contracts, a serious threat to Houston-based exporters. Natural gas prices dropped 8% in one day and investors in energy stocks braced for a rough quarter. But here's the most chilling part. In a small Pennsylvania town, a family-owned tool manufacturing business 93 years in operation posted a heartbreaking note on its storefront. "We survived the Great Depression, we survived 9/11, we survived COVID-19, but we couldn't survive this." That wasn't a political statement. That was the raw economic truth. The trade war, sold as a defense of American industry, had instead trapped small businesses in no-win scenarios. Pay the tariff and lose profit. Absorb the cost and close shop. Raise prices and lose customers. This was economic warfare without a front line. Everyone was a casualty, from stockholders in Manhattan to a factory line worker in Ohio. April 8, 2025, 6 a.m., Eastern Standard Time. While most Americans were waking up to rising prices and vanishing jobs, a very different scene was unfolding in Lower Manhattan. Inside a dim-lit Bloomberg terminal room at a top investment bank, analysts huddled around monitors, watching two key graphs: the US dollar index, the Shanghai Composite. Both were falling fast. But not everyone was panicking. Some were placing bets. By 10 a.m., hedge fund managers were already pivoting, reallocating assets into commodities, emerging markets outside of China, and defensive plays like healthcare and utilities. The smart money knew one thing: volatility breeds opportunity. Meanwhile, in D.C., the Federal Reserve's Open Market Committee was holding an unscheduled call. The trade war was beginning to choke growth forecasts. The Fed feared a drop in consumer spending, tightening credit, and slowing hiring, a triple threat that could spark a recession. Quietly, they began discussing an emergency rate cut. By noon, whispers of this potential rate adjustment had already reached Wall Street. The market spiked not on fundamentals, but on hopium. The idea that the Fed might rescue investors led to a temporary rally in the S&P 500 and the Dow. But don't let the green fool you. Behind that brief jump was fear. Investors were sprinting toward safe assets. Gold crossed $2,150 an ounce. Treasury yields dropped. Bitcoin surged 11% in 2 hours as crypto became a modern-day safe haven. But the real action wasn't in the charts. It was in the conversations no one televised. In a closed-door meeting at the White House, major CEOs from Amazon, Apple, Ford, and Exxon gathered with the Commerce Secretary. They weren't there to pose for photos. They were there to warn. "We're not just bleeding," one CEO said, "we're hemorrhaging. The longer this lasts, the more permanent the damage." At the same time, China's Ministry of Commerce was holding a high-stakes press conference in Beijing. The language was sharp: if the US escalates, we are prepared to sever high-tech trade ties. That line sent shockwaves through Silicon Valley. The Nasdaq, which had been wobbling, plunged 3% in an hour. By evening, the US government leaked plans for a tech innovation stimulus bill, a $500 billion package to boost domestic semiconductor and AI development. But passing that, it would take weeks, maybe months. In the short term, one thing was clear: the market was on its own. And how did the giants respond? Apple accelerated its plans to move manufacturing to India and Vietnam. Microsoft began stockpiling AI chips from Taiwan in anticipation of further blockades. BlackRock and Vanguard began offloading Chinese ETFs quietly, strategically. This wasn't just damage control. This was wartime finance. Executives and fund managers were no longer asking if there'd be losses. They were focused on who would lose least and how to position themselves for the rebound. And that, dear listeners, is the real game behind the game. April 10, 2025, 7 a.m. Eastern Time. 4 days since the first tariff shots were fired. Stock markets had lost over 2.3 trillion in value. Over 600,000 export-related jobs were now in limbo. Consumer confidence was plunging. But behind the scenes, something deeper was happening. The global economy wasn't just reacting to the trade war, it was realigning. At the IMF headquarters in Washington, D.C., Managing Director Kristalina Georgieva made a statement that rattled the international finance world: "This is no longer a trade dispute. This is a decoupling of two global superpowers. The world must prepare for a bifurcated economic future." Bifurcated. That word hit hard. It meant two separate tech ecosystems, two supply chains, two trade blocs, one led by the US and the other, by China. The globalized world as we knew it was fracturing. And from an investment perspective, that meant both risk and opportunity. Winners, losers, and strategic moves. Winners: India, Vietnam, and Mexico emerged as hot new manufacturing hubs. American and European companies rushed to relocate operations. Defense contractors and cybersecurity firms saw stock surges. In a world that was decoupling, protection was the new profit. Domestic AI and semiconductor startups saw billions in new funding. The US government, spurred by national urgency, fast-tracked approvals and tax credits. Losers: US farmers lost over 16 billion in projected exports for the year. Tech companies relying on rare earth metals from China scrambled to find new sources. Chinese manufacturers, especially in the coastal regions, faced widespread layoffs. For them too, the war had cut deep. But the most critical shift came from the American consumer. Surveys revealed a new mindset: less dependence on foreign goods, more demand for made in USA. Whether driven by patriotism or protectionism, it was a permanent shift in buying behavior. That's when Walmart, in a landmark move, announced, "We're committing 50 billion to domestic sourcing by 2026. It was a bellwether moment. Retailers, investors, even small businesses followed. And the markets, they began stabilizing, not because the war was over, but because a new normal was forming. You may be wondering, how do I invest in this new world? Here are 3 key takeaways. Follow the redirection of supply chains. The US and its allies will invest heavily in domestic and regional manufacturing. Think infrastructure, ETFs, robotics, automation. Bet on energy independence. The US will accelerate renewables and LNG exports. Look at companies tied to clean tech, battery storage, and pipeline logistics. Watch the digital divide. With the rise of two global internets, the US-led tech stack versus the China-led tech stack, investors can find huge upside in data security, AI ethics, and quantum computing. This trade war may not have fired bullets, but it wounded markets, communities, and partnerships that took decades to build. Yet, in every economic storm, comes evolution. The investor who thrives is not the one who avoids risk, but the one who understands where the world is going, not where it was. The past was global. The future is fractured. But for those who read the map right, it's still a land of opportunity.